everybody. This is Daniel Wynn, and I want to welcome you to the Daniel Wynn podcast. Today, I'm excited to share with you some hard-ass lessons that I've learned being in the private lending business and buying real estate. Because we always talk about the wins, right? We talk about when we sell something and we made a profit and we get that big check, and then we put it on Instagram, you got a big check. But what I want to talk about is the lumps and the lessons you learn along the way, because you know the saying, no pain, no gain. And in this game of real estate lending and investing, there's always lessons to be learned so we can have bigger guns. So I want to talk about foreclosure trends. It's the beginning of the year. I want to talk about where we're headed with foreclosures, how you and I and we can take advantage of these. I want to share with you a horror story with some closings. And I want to talk about the risks of flipping properties and how you could flip properties and joint venture even if you don't have a lot of your own money. So let's begin. What we're looking for the trends for the beginning of this year is that foreclosures are constant. They never go away. And the trend is that they are moderate, right? We are not seeing big spikes in foreclosure because people have locked in so many low interest rate loans. And the states with the most foreclosures are some of the predictable ones we could imagine, right? California, New York, Texas. They're the states with the largest population. Florida and Illinois. They all lead the way with foreclosures. So if you're in any of those states, you have ample opportunities to score points and get your fair share of foreclosures for this year. So the question is how are you going to get those foreclosures? Hopefully you already have a strategy, you already have some marketing methods that work, and that you're ready to keep rolling those out like we are. We're always looking for distressed property because that's how you make the big bucks, right? We make a great living doing private lending, but we score big points just like all rehabbers and house flippers and wholesalers if you can buy right and then sell it at a higher price. The next thing I want to talk about is REOs. If you have the ability to buy from banks, then that is potentially a good thing. Banks are normally not good landlords, right? We're not talking about hedge funds, we're talking about banks. So if you can figure out a way to get a hold of bank-owned property, you should consider getting on those lists and developing those relationships. Our private lending company sometimes forecloses on properties, and we have REOs that we offer to the people that are on our email list. So if you are not on our email list, get on it. So when we have these opportunities available, we would be happy to share them with you. Okay, now I want to talk about some lessons that we learned and had to pay for that maybe you won't have to pay for if you could take this advice and use it, right? So what I want to talk about is some loan applications and some closings that went all the way through the process, right? Loan application, loan approval, appraisal, title, loan process, documents all turned in, and then the documents are prepared. The lender sends the documents to the closing, and the money is wired to the closing, and then things go wrong. Now I want to share this bad story with you, but I want to tell you that most of the time everything goes perfect. But once again, we don't want to talk about all the times everything's perfect. We want to talk about, the hard hits that we often have to take to grow as business people and as real estate lenders and investors. So I want to talk about this miscommunication that it can be caused when a loan application does not close. And there's many reasons, right? Like maybe the borrower omitted some of the information on the initial application. Maybe the lender issued a loan approval and didn't add one of the stipulations. Now, most of the lenders have some fine print in there that says that if we forgot something, we can ask you for it later. And that sometimes happens. But you can imagine that you go to a closing, and I'll give an example. You're flipping a house, it's a major rehab, and the loan approval or the clear to close says property insurance, right, for a certain dollar amount. Well, you get to the closing And then the lender says, oh no, we needed builder risk insurance. Well, that's a different policy. So now you have, in some states, lawyers still go to the closings. So you have lawyers sitting at the table, you have the realtors, everybody's sitting there to wait for this buy of this rehab investment property so they can all get their money, right? The two lawyers, the buyer and the sellers, the two realtors, the buyer and the sellers, and the property owner. So if this condition is not caught in time, the condition being they need builder's risk versus regular property insurance, this could cause a problem, and it does, and it did in our case, and that's why I'm sharing it with you. So if you are working with an experienced lender or broker, then they should be able to get that policy done the same day. If you're not, the closing might actually have to take place again, right? And everybody went there and drove in their cars, got in their cars, got out of their offices, got out of their homes, and go to the closing, and it doesn't disperse. So the lesson that I'd like to share with you is that if you are the borrower, you should double check these things. And how do you double check them, right? Well, you double check with the title company, you double check with your lender or your broker, and you cross your I's, dot your T's, and hope and pray that there are no surprise conditions. Let's also talk about miscommunication between the buyer and the lender. The buyer oftentimes has to bring in a certain amount of money, and some lenders require that they source the funds, and that means the funds have to be in the bank account for a certain amount of time, and some don't. So this is an important question that you should ask, because sometimes you don't have all the money sitting in your checking or business account, and you need to pull it from wherever. That could be a retirement account, that could be from a friend or family member. So that's another important thing that you should learn and ask when you're dealing with a lender. Is there a seasoning on the down payment amount and the closing costs? Takeaway is that you should always get everything in writing, go through the checklist before you go to the closing, communicate with everybody properly, and the majority of the time your deal will close and everybody will leave happy the way it's supposed to be. Next item I want to talk about is the transparency, once again, between lenders and investors and mortgage brokers, right? Because mortgage brokers are often involved. They are the middleman between the borrower and the lender. And a broker sometimes, not that I've ever seen this happen, but brokers could omit some valuable information that the lender needed to know in order to close the deal. So I believe when I was a broker that, and I still am, but majority of deals we fund in-house, but we still broker some of the larger deals and deals that have higher loan amounts and higher loan to value requirements. I always believed that it was best to be full disclosure, right? To give full disclosure to your lender, put everything that you know on the table. Now, if there's an item that needs the lender's opinion, if you have a good relationship with your lender, that lender is going to tell you, yeah, Dan, I don't need this. Give me that instead. Or yeah, get rid of that because that's probably not going to go through well with underwriting. Our underwriters will not need that. So don't submit it. You'll only raise questions and maybe impede the loan process. So the relationship between broker, borrower, lender is a very important relationship. And the reason why it's important is because you want to have a lender that you can go to when you find these great deals. If you have the ability to find undervalued real estate, you need a strong lender or two that will have your back. And once you have closed loan number 1, loan number 2, loan number 3 with your lender, it should be easier for you in the future and faster for you to get your next loan approval and closing. So don't lie to your lenders. Don't lie to yourself. Be transparent. This is what I got. Put your cards on the table. See if that works for everybody. And let's build long-term relationships that are win-win. Another thing that I would say is if you're a broker, don't try to get lenders to accept deals that you wouldn't fund yourself. I always have that philosophy that I would not ask my private lenders to fund deals that I wouldn't put my own money into. And in case they ever deny me, like they say, yeah, I don't want to do that deal, Dan. Many times I've asked them if I put money into the deal, would they then fund it? And many times they said yes. If I was going to invest side by side with them, they did then change their mind and fund some of those deals. So if you want to be a super broker and not just a regular broker, you're going to put your money where your mouth is, and you don't want to send loans that don't have a high probability of closing because they're low risk and good loans in good areas. So another subject I'd like to speak about is why flipping homes is really riskier than you think, right? I think oftentimes real estate investors that are new to the game, or even if they've been in the game and they've got a little bit of confidence and success, that they could underestimate the following areas that I want to go over and hopefully have you think about these before you get involved in your next transaction. So let's debunk the get rich quick myth, right? You don't get rich quick in real estate, right? You get rich slowly if you do it correctly. Here's some of the risks that I see from borrowers that submit loan applications to me for rehab loans and investment property loans. They underestimate the renovation costs. There's so many variables, right? And the variables are not just material costs, contractor costs, holding costs, and regulation, right? If you have to get permits and things like that. Those can blow out your budget. You really have, if you're buying a property for 100 and you're fixing it for 150, you better be darn sure that you can sell it for 200, right? And not over it. This is another risk, or this is another mistake that rehabbers and investors make. They underestimate or they overestimate the value of the property that they're going to be able to sell it for, which means that if you think you're going to sell it for 200 and make a net $50,000 profit on that example I gave you, if you could only sell it for 180 and then you got real estate commissions and closings, you may have went through that whole ordeal of buying, selling, rehabbing, the months involved, the time, the energy, only to make $10,000, $15,000, $20,000. Now the good news is, if that happens, you won, right? You had a positive outcome. But if you underestimate your construction costs and you overestimate the value, you could end up making zero or lose money. So I would caution you to really underestimate the value that you will sell it for. Instead of thinking 200, think 180, and it's bonus if you get the other 20. And when you're doing contracting estimates, always add another 25%, worst case scenario. No matter what they give you, there's always surprises when you get under the hood of some of these rehab projects. So in conclusion, I would say that it is riskier to flip properties if you underestimate or overestimate. And it is riskier those first few times that you're doing this for the first time because you've not learned these lessons. You should lean on a good lender, broker, real estate attorney, people that have actually done this for a living to help you make these good decisions for you so you will be successful in your career as a real estate investor. Last thing I want to say about the risk of flipping properties is I have a philosophy, which I shared earlier. You make your money when you buy, not when you sell. If you buy right and then you got your construction or selling costs correct, you will always make a profit. And that's the way that I've been approaching real estate the last 7 years, and it's been served me very well, and I'd like to share that with you. So to recap what we went over today, there will be a lot of opportunities in foreclosures and tax delinquencies because we live in such a large market, right? If you're in any of the large markets, the top 20, 30 markets in America, there's a lot of opportunity. There's an old housing stock here in America. There's people that are passing away. There's people that are losing their properties for various reasons. There's people that are getting divorced. So focus on those distressed properties and buy right. Always communicate properly with your lenders, your title company, your attorney, and be honest and get deals done the right way, and it will serve you well in the long run and in your career as a real estate investor. And last but not least, don't underestimate construction costs and don't overestimate the values of properties you're going to sell them for. If you have any funding needs, send us an email, give us a call, fill out a form online on our website. If you like this information, share it and like it. And if you have any joint venture opportunities, what's a joint venture opportunity? You found a property, it's $100,000 on the market. You want to buy it, but you don't have any money. You're all tied up with other projects. Call our office, see if this deal qualifies. We'll put up 100% of the money, and we'll do an equity split on any of the profits that we can gain together. So with that said, until the next podcast, have a great day. See you next time. I'm Daniel Wynn with the Daniel Wynn Podcast.